I got this question on 529 plan investments for the short term, 1 to 2 years out. And I thought it'd be a good topic to tackle, mainly because I haven't talked too much about short-term investing with the 529 plan, more that long-term time horizon with basically choosing like an S&P 500 fund inside of the 529 plans. And this is a real challenge, I believe, inside of the 529 plans, because I don't think the short-term investments are as good as they should be. But I wanted to walk you through kind of what my thought process is. And before I read this question and we go through this, I just want to say that there's no one size fits all investment choice. So maybe this works for you, maybe it doesn't. Maybe you take what I'm about to tell you and you adapt it to your own plan. So just keep that in the back of your mind as we're going through this. So let me go ahead and pull it up on the screen and read the question and share some of my thoughts. So the question says, what type of short-term investment plan would be good for 5 to 10,000 over a year or 2 years before withdrawing to apply an education? Now, this is off of one of my earlier videos of this whole channel, 529 College Savings Plan Explained. And it doesn't really matter that it's just 5 to 10,000. Maybe it's 1,000, maybe it's $500. It doesn't really matter. The amount in the short term is sort of irrelevant in the grand scheme of things. But let me walk you through. I'm going to use the Florida's 529 plan as an example to show you what I would look at and to kind of put it together for you. So let me go ahead and pull that up on the screen and show you what I would do. So here's Florida's website. It's called the Florida Prepaid website, but they also have their savings plan. And that's what we're going to look at, because that's the type of plan that you can choose your own investments in the 529 savings plan. So let's take a look at the investment options here. And they break it down into simple, intermediate, and advanced. I'm just going to jump to the advanced, and that's because you can choose your own funds. That's what the advanced really means. So it's kind of leaving you to choose the allocation. So do you want X percent in any one of these portfolios? To some, this might be a little overwhelming. Totally understandable if you're not familiar with investments, but this is what I do, so this is what I like to look at. So what I would choose in the very short term is going to have basically no to very little risk. And if you're looking at some of these options, it might feel a little misleading, like the one right here, money market fund, you might be familiar with. But then you look at this, a high yield fund, that sounds good because, hey, I want to make a lot of money, so why not choose a high yield fund? So just right from the get-go, this could feel really overwhelming, but I'm going to show you what I would choose 1 to 2 years out if I'm going to invest any amount for almost any goal. This doesn't have to be just for college savings. This is going to be almost for any goal. So I would look at, given these options, I would look at the money market fund. Now, when we're looking at this, we might also be curious of the investment performance. So if I jump to the performance, because all these different plans give you the performance, and it's kind of misleading because these are historical numbers. You're trying to make an educated guess with these historical numbers, but they don't mean a whole lot in the grand scheme of things. And here's why. So if we look at the short term, let's say like the 1 and the 3 year, because we don't have a 2 year here, and we're going down all of these numbers, we might say, okay, well, he mentioned the money market fund. And yeah, in the last 1 year, it was 5.69%, but it really didn't do well since inception relative to some of the other funds out here. It's only at 1.57%. So with the money market funds, one of the reasons those are doing well is because rates have increased. Now that rate increases usually gets bad press because you see mortgage rates increasing. But when it comes to money market funds like that or new bonds, those rates tend to rise. But bond funds overall, which are considered fixed income, those tend to fall, because if you have something that you can get for a higher rate, well, then why would you want that lower rate, right? Why would you want that lower rate if you're selling it to somebody? So we're trying to buy that. So for example, if you have $1,000 and you can either give it to one investment fund and it's earning 4%, or you can give it to another investment fund that's earning 5 or 6%, which one would you choose? You would choose the one that's paying 5 or 6%, not that 4%. So therefore, the one that is paying 4% tends to go down. The principal number goes down. So that's that $1,000 investment. So you would say, you know what, I'm not going to give you, I want to make my 4%. I want to make my $40 per year on that, but I'm not going to give you $1,000 to make that $40. So think of it like a seesaw. So you're going to pay less than $1,000 to get that same $40. That's how basically bond funds work. So in a nutshell, so that's why the current bond funds would decrease. So if you're invested in fixed income, you've probably seen that decrease, and you can see that right here. If we look back at it, we can see that the core fixed income funds have dropped in this short term period. Why? Because again, rates have risen. So those things that are relatively conservative have decreased. So that's what you're going to experience there. Now, it's also over time, sometimes it masks some of the returns in the short term. Because if you look at a 10-year time frame and you still have positive numbers, there could be negative years in there. And if this fund hasn't been around for that long, that's where the NA, not applicable, comes in. But let's just ignore that for a second. If you just look at the since inception, longer time frames, they tend to be more positive overall, even though, again, this fund right here hasn't been around that long. That's why it's still pulling that negative number there, again, because of those bond rates. So I know this probably sounds a little bit confusing if you're not familiar with investments, but that's how they work. So to me, it's a little bit misleading to say I'm going to go into fixed income and buy a bond fund. That's not the way that I would go. And that's what a lot of these actually easy buttons tend to lean towards. So let's go back to the investment options. So if you're one of those, hey, this says most popular, simple, easy to invest, they're going to build a portfolio for me. And as we get closer to school, it's going to get more conservative, taking on less risk. And that sounds great in theory. But when we actually look at it, it's not working out well, especially in this kind of a market. So if we look a little bit closer, we can see here, view underlying fund and allocation for the enrollment year portfolio. So if we take a look at it, we could see some of those funds. And if I'm scrolling down here, and here we go. So you see the enrollment date. So if we're looking at 1 to 2 years out, you're looking at 2025, 2024, 2026. You're looking at all these time frames, right? So right now we're in 2024. So really 2026 and 2025, 1 to 2 years out. And we look at the allocation. So we see that these are the funds up here. We can see them up here, and we can see the tickers. The tickers will allow us to go actually look at the fund a little bit closer, but we can see what percentage is in each one of these funds. So for example, if we look to, I'm just going to use 2026 right here. The most amount of money is in this one fund. So 68.75% is in this Vanguard Core Bonds. Oh, you know what? Maybe you've looked at Vanguard and you say, you know, I've heard of a lot of good things about Vanguard. Just because you've heard of good things about one company doesn't mean all of their funds are good. So, and it doesn't mean they're not necessarily a bad bond fund, but relative to other choices that you can invest into, it might not be the best choice. Again, it matters for your particular situation. So I'm just trying to give you some things to think about, not necessarily telling you exactly what to do. So let's go ahead and just Google this. I'm going to go pull it up, and it's right here. So this is the page for the VBMPX. So the ticker is how we can actually look up the fund. And if I look at this performance and fees down here, we can see annually. So we could see what it did each year. Look at what it did in 2022 and 2021. So it was negative. So the total return is really what you want to look at. That's net of all fees. Total return by NAV, net asset value. So it's down 13.14% and then down 1.65%. And I'm not pointing this out to say this investment is poor because of negative returns. What I'm pointing out is that this was billed as a conservative option, that it is the 1-2 year option if you chose a simple allocation with a target date enrollment fund. You also see these with retirement plans. But the difference between retirement and education planning is not something that we tend to delay. You're going to go to school. Your kid's going to go to school when they're going to go to school. Unlike retirement, if things don't plan according to how you thought they would, you can delay retirement. There's things you can adjust, but when it comes to school, the timing is typically not something that you're going to want to move back. So even though this was billed as something conservative, it's not how I would build the portfolio. Now, you can check back at my previous videos from 1, 2, 3, and 4 years ago, and I really have said the same things all along, that I would not choose these bond funds. I tend not to like bond funds for these reasons, and they're not as steady as a lot of people would like them to be. Now, what I would do in the 1 to 2 year range, given these investment options right now, would be to invest into the money market. Now, it's not a guaranteed fund. Money markets are not guaranteed, but you're highly unlikely to lose money in them. And right now, since the rates have increased, the money market funds are actually doing relatively well to previous years over the last 10, 15, 20 years. So those rates are looking pretty good. You're getting over 5.5% on your money versus saying, you know what, let's reach a little bit further for 10 or 15%. But that negative consequence is a downturn in the market. So that's how I would look at it. Now, as I said in the beginning of the video, it really depends on your particular situation. Are you really going to use this money in the next 2 years? If that's what you're going to do, that's how I would actually invest in it. And sometimes that comes to you needing to save a little bit more to actually reach that goal. Maybe that return isn't enough to kind of meet the goal in addition to what you can actually save. So this poster said 5 to 10,000, and if they need 15 or 20,000, then a 5% rate of return isn't going to cut it. But again, it goes back to your particular situation, and you probably should look at other things rather than reaching for a better return just because it has a higher number. And as I mentioned at the beginning of the video, the high yield savings fund, it sounds great. I want high yield savings. Those are another name for that is called junk bonds. So that puts an image in your head that you probably don't want junk bonds in your portfolio. And they do have a lot higher risk. Those are high risk bonds. High yield bonds are high risk. So you have to look at these with a little bit closer than just saying, you know what, there's an easy button, let's do the target date fund. I just don't like these target date funds. I never have. And these are the reasons why. And unfortunately, you don't have a lot of short-term investment options inside of 529 plans. Now, they've gotten way better over the years because if you look at some of my early videos on this channel, I didn't even like 529 plans. So now I like them because they have low-cost ETFs, and you can just go ahead and get one of those S&P 500 funds in a lot of the 529 plans today, which is not something that you could have gotten years back. So these things change, so you have to keep after them. You don't have to look at them every single day, but you have to understand what you're investing in. And sometimes, in my opinion, the easy button isn't the button that you want to press. You want to make it as easy as possible, but you really want to do what's right for your particular situation. So hopefully this has helped make it a little bit clearer on kind of what you should do in the short term. Not a lot of great options to use in the short term. So that's why I would lean towards the money market fund, not take on any risk, not have to make decisions that you really don't want to make. Not saving enough means you can't go to the school, your child's school that they really want to go to. Maybe that's unaffordable at that point. Then you have to look at alternative options. Don't put yourself in that position. Plan early, save often, and hopefully this has helped. If you have any questions, let me know in the comments down below. And if you've enjoyed this video, be sure to subscribe, and we'll see you on the next one.